Okay, everybody, welcome and welcome back to our Optionetics students. I'm Tom Gentile. I am still here. It has been 3 years since the last time I did an Optionetics seminar. And as you can see, it's been 3 years. I've been wanting to put this shirt back on for 3 years here, guys. But I'm back. I'm glad to be back. Jay Harris is with me. Welcome, Jay. How you doing?
Doing real well. Nice to see this community expanding and growing and everybody coming back.
Absolutely. And, Jay was in the back of many of these seminars as support. And, I'll tell you a little bit about what happened, what happened in the last 3 years. But Jay's been with me now pretty much ever since we started. Anyway, guys, this is our Trading Essentials webinar series. This is going to be a 4-part series. We're going to do 3 to 4-part series on a regular basis, throughout as long as you want to come back and learn. Each one of these will be different. My plan is that we're going to focus on some fundamentals during the first few weeks, and then I'm going to have a wild card week, which is going to be our last piece. And that's going to be dealing with some type of a market strategy, some type of strategy that's working in the markets right now, whether we're in uptrends, downtrends, sideways, delta, neutral, directional, you name it. That's going to be our plan. So again, Tom's Trading Essentials, glad to have everybody here. Now, got to do a little bit of housekeeping like we typically do. So let me move on, and I'm going to get rid of my screen or my camera for a moment. This disclaimer, I'm going to talk about this in just a moment, but I want to give you some ground rules of what we're going to do here each and every week during our Trading Essentials webinar. Number one, the session is being recorded. All right, I'm going to have the recording out to you as soon as I possibly can. All right, which typically for us, any of you that are in here that know me and have been associated with my my company, Tom's Trading Room, we get these things out to you within a couple of hours. However, because this is a larger group, because I'm dealing with a transitioning period right now with Charles Schwab, it's going to take a couple of days for me to get this to you. But you'll get it. Don't worry, you're going to get it from us. All right. Second thing is that there are so many of you in the room tonight. Thank you very much for being here. I'm going to apologize to you right off the bat because I'm going to say this. If you have questions about anything that we're covering tonight, feel free to ask them in the Q&A box there that's on the client side of this webinar. All right. We will pick the most popular questions. I'm not going to be able to get to them all. I can tell you that right now. But if you do have questions and you feel like they haven't been answered or you need to have them answered, we'll get to them. All right. We may not be able to get to them tonight, but we will answer your questions for you. Finally, the disclaimer you see on the screen. So I do this with every single webinar that I do. And you can read this from beginning to end on the recording that you will get from us. All right. Following the live event, I want to mention just 2 or 3 things here. Number one, in big, bold, black letters at the top, stock and options trading has large potential rewards, but also large potential risk. I want to also mention that Optionetics, myself, Jay, and everyone associated with Tom's Trading Room, we're here as your educators, right? We're here to show you how we trade, right? We're not investment advisors. We don't give specific trading advice. You need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in US dollars unless noted otherwise. And now let's go ahead and move on. For those of you that are catching up with me, all right, kind of wonder where I've been in the last 3 years. My background there, you can see it all there. It's been doing this for over 25 years. Was the co-founder of Optionetics and now the refounder of Optionetics. We've got several books in print. Like I said, I was talking off the recorder, but I do appear on CNBC. All right. I've done CNBC, Bloomberg, Reuters, Fox Business, and more. I typically am on CNBC. I am on CNBC World. I do a program there called Capital Connection. So every once in a while they invite me in. And I typically am talking during earnings season. So I'm talking about earnings and earnings season. If I could tell you right off the bat what I was covering last earnings season was that I liked NVIDIA and I hated anything retail that was something you had to step into, a box store, all right? Amazon, completely different. That's the reason why I hate retail, by the way. Also, I am the founder and editor of TomGentile.com, Tom'sTradingRoom.com, and Tom'sOptionTools.com. All right. So what have I been doing the last 3 years? Well, I told all of my Optionetics students that I would never leave Optionetics, that the only way that I was going is if I was pushed out. All right. So what ended up happening? Like any big company that takes over a smaller company, um, it got to a point where Schwab did not renew my contract. All right. Hey, it happens. All right. But we left it was mutual, no hard feelings. And of course, here we are almost 3 years to the day, and I'm back. All right. Long story short, we acquired Optionetics back from Charles Schwab. So we took a public company, or a company that was owned by a public company, back private again, which is fantastic because I can do things at a much greater speed than a very big company. I can get back to doing what I love doing, which is teaching people, teaching our Optionetics students what I have been doing. What have I been doing the last 3 years? Well, I wrote another book, which I'm going to give you access to. I also started Tom'sTradingRoom.com, and several of you in here, all right, several of you in here have been with me for years now, all right, and so we'll talk about that a little bit too. But I wanted to basically say welcome back to our Optionetics students. We're going to be offering not only the Trading Essentials webinars on a regular basis, but we're going to be doing also special one-off webinars, which I'm going to be inviting you to. And those may be something in terms of credit spreads, how we trade credit spreads, how we trade straddles, how we trade collars. We may be talking about particular systems and strategies. We may be talking about calendar spreads or butterflies. Okay. But this is part of our program that we do. The best part about this is that the majority of our education is online, and A, you don't have to leave the house to get to it, and B, we're going to give you the recordings. In almost every situation, you'll have access to those recordings. Also, I want to mention to our Platinum users, we had some Platinum users. I actually had a meeting with some of our Platinum users that were still using Platinum, and Platinum has now merged into. We've also acquired Platinum. We've got a major upgrade with Platinum. It's called Tom'sOptionTools.com. And I'll talk a little bit about that too. But we have a limited free time subscription to Tom'sOptionTools.com as kind of a celebration for getting back together with our Optionetics students. And then finally, this is for all of you, because I invited everybody to these 4 weeks. For all of you that are Tom's Trading Room members or Mastery members, or you're in our partner program. The premium education that we give you, including the Mastery series, the Partner series, those proprietary buttons that we have on the website that are just for you, that all stays the same. Nothing is going to change. So like I say, nothing is changing. Let's keep on trading. Okay, if you go to Optionetics.com, you will now see this on the screen. And that is because very, very recently, the Charles Schwab Corporation has shut down the Optionetics site and the Platinum site. And so now we have an area for you to go to get to certain things. If you want to learn a little bit about Tom's Trading Room, there's a little button you can click on over here to the left. If you're a returning Optionetics student, I have a message for you there. Platinum users can click here. We have an upgrade, major upgrade, even if you were a past Platinum user. Got a really cool upgrade for you. Tom's Option Tools, you can log in right here. And then a little bit about me and what I've been doing, both on the trading side, on the talking side, on the teaching side, on the charity side, because we give a lot to charity too. You can check that out right there at the Who is Tom button. All right. Let's talk about Trading Essentials webinar. This webinar is going to be every Wednesday in June from 8 to 9, may go to 9:30. All right, I'm not going to stop talking just because it's 9 o'clock. If I'm finished with what I got to say, great. If not, I don't want to make this so speedy that I miss educating you. Recordings, like I said, will be made available and emailed out to you after the live event. And also, any slide handouts that I have from the webinar are going to also be made available to you. So I'm going to make sure that I zip up these slides and give them to you in a PDF format. Okay, my webinar agenda looks like this. tonight is week one. We're going to talk about stock selection. You know, I thought about, getting into our Trading Essentials series. And probably the most essential thing we need to do before we even start trading options is know what is worth trading and know what's worth leaving behind. Do you know that 90% of optional stocks out there are junk? And you need to just let the junk lay. Let's deal with the top 10%. So I'm going to talk about creating the best stock list, all about options. We're also going to talk about calls and puts. I've got a couple case studies for you that are very relevant to today. Next week, week two, we're going to talk about a review of week one. We're going to get into something called channel collisions and looking at channels and understanding how to look at channels. I actually may have one or two charts tonight to tease you with, but we're also going to talk about something called trading the darknet strategy. All right. Darknet, by the way, is my way of trading Elliott Wave without the wave counts. Week three, we're going to review week two. We're going to talk about spreads. We're going to talk about trading a money calendar. All right, trading with a money counter. And then week four, we're going to talk about something I like to call RBT trading, or becoming a rules-based trader by spotting and back testing opportunities. All right. Do you know we can back test now? Guys, how far? I can't tell you how far we've come. It's absolutely amazing how far we've come just in the last couple of years. Not only can we back test stock strategies, but we can back test and auto back test options strategy. So if you have a directional trading strategy, used to have to manually back test options, and we still do that, where you can put in a date and then move forward and see how it did. But how'd you like to take a strategy like, for instance, I'll throw it out there, the 1030 moving average, one of George Fontenelle's favorite strategies. How'd you like to take that and auto back test it, not only on stocks, but what options performed the best during that auto back test? All right, back testing on calls, back testing on puts, back testing on spreads. All right, we have that capability now. That was not available maybe not even a year ago. It's now available, and we're going to be getting into that too, because it's important to realize that, at the end of the day, I'm a pattern trader. I trade patterns. I want to teach you those patterns, and I want to show you how we can back test and spot those opportunities, and then create the low risk trades and create the trade management that goes along with it. So today we're going to talk about stock selection, my stock list, the 3 best time frames to trade, options basics and not so basics. I want to take you through this week's market outlook. I got last week's on there, but I decided I'm going to show you this week's market outlook. And then we're going to go through a homework assignment for you, which I think you're going to find this is going to be a very good homework assignment. You're going to love this one. All right. So let's start with tradable stocks. All right. So there are roughly 20,000+ stocks out there in the stock universe. How many are optionable? Somewhere around 4,000, give or take a couple hundred. All right. When you dive into these areas to try to sift out the good, the ones worth trading from the ones that aren't, there are 3 areas I like to go into. One is market liquidity. Number 2 is stock mobility. And number 3 is it short-term optionable? So let's talk about each. Let's talk about market liquidity first. All right. So one of the things that I want you to understand how to do is to create a stock list. And it can be a small stock list or it can be a big stock list. But my biggest stock list, my preferable biggest stock list is no more than 400 stocks and ETFs. Right? Now, how do I take 4,000 optionables and sift down to the top 10%? You could go by looking at stock volume, but that's not the way I do it. All right, the way I do it was with something called the penny pilot list. So what I want you to do is I want you to jot this website down. All right, trust me, I'd love nothing more than be able to have everything you need at my address, at my website, but it's just not going to happen. All right, so there are areas where I'm going to give credit where credit is due. Tonight, I want to talk about the CBOE. The Chicago Board Options Exchange has it's a nice area to get educated on specific products, specific options contracts. The other thing they have is they have some downloadable lists out there that you need to be aware of if you don't already know this. So I want to ask a question to those of you that are on the call right now with me. And the question I have is this: how many of you in here do not know about what's called the penny pilot list? How many of you have never heard of this before? All right. If you have not, just put something into the Q&A box. Maybe say me. Maybe say I haven't. Maybe say no. So that I get an idea how many people I'm about to teach this to. Wow. Wow, wow, wow. This is fantastic. Jay, it's possibly hundreds of people are popping in saying that they've never heard of this before. This is fantastic. We're not even scratching the surface, and you're already going to learn something tonight.
Glad we've got these guys all back to take care of them now.
Absolutely. So what I want you to do is this. There's something called the penny pilot list that you need to know about. This is a list of stocks that have options where their bids and offers trade inside the 5-cent window. All right, so they trade for, let's call it 4 cents by 8, or 4 cents by 5, or 55 cents by 58 cents. All right, they're inside the nickel spread. We all know, and I'm going to give Peter Ox props for this. He used to, one of his favorite questions when he did seminars is he said, what's an option trader's best form of liquidity? And he used to say stock volume, option volume, open interest, or bid-ask spread. And the answer was bid-ask spread. And so, that's great for an answer, but unless you know where to find these options that have the thinnest bid-ask spread, you're doing a lot of looking manually. This is one way you can do it, and it's actually quite simple. So what you're going to do is you're going to go to that CBOE website. All right. In fact, you can even do better than this. Just go to Google and Google in the words penny pilot program. And when you do, this one should pop up on top. It says CBOE hybrid penny pilot program, CBOE.org. And if you click on that little link, then you're going to see this pop up. It's small. I crunched it down, but you'll see the website. And in there, you're going to see the penny pilot program. And it's going to say, click here for a .csv file of penny pilot classes. Now, basically what that is that's going to be an Excel or a Word spreadsheet, a form with every stock and its symbol that is in the penny pilot program. All right, this is a program, by the way, that started back in 2009. Okay, and then it just started gaining momentum. It started out with Google. I believe SPX was on there, and Google, and maybe a couple other symbols. Now it represents over 375, actually over 400 when you look at the ETFs that are included too. Right, so right there, so many people have now learned how they can sift through. And why do you want this list? Because it's efficient. All right, nobody likes going to a car dealership and seeing the spread between what you want to pay for a car and what the list price is on that car be very, very wide. Okay? You want something where what the price of the car is and what you're willing to pay for it is very, very close together, because then you're getting a good deal. Well, one way we know we're getting a good deal with options is when the bid-ask spreads are very, very close together. Stocks like Apple, Facebook, Snap. Snap's been a option that hasn't been around that long, but it has very, very liquid options. Okay, so that's the penny pilot program. The other thing I like is short term. It must trade weekly options. So penny pilot program, once we add the weeklies in there, that crunches it down even more. All right, so I like stocks whose options are both penny pilot and they have to have weekly options. I got to tell you guys, I spend more of my trading time trading anywhere between 1 week and 1 month than I ever have before. You know, I used to take the long stuff, and yeah, I do some stuff with the dogs of the Dow, and I do some stuff with options that are, you know, greater than 30 days. But the majority of my trading is in that 1 week to 1 month area. Jay, where do you spend the majority of your time? I know you're not a long-term trader, and you might have your microphone muted. So unmute that. But for me, well, I've got today, for instance, I got half a dozen positions open today. I'd say majority of them are the expiration is next Friday. All right, next Friday. And then I'll start looking at, you know, I look at stuff every day, but I like to find liquidity and I like to find short-term trading strategies. So that's another area. So to get from 4,000 to 400, basically top 10% of all optional stocks, we must incorporate both the penny pilot options and the weeklies into one group. And so, you know, what we'll look at is a list that I have on our tools called pennies and weeklies. Right, so pennies and weeklies are within Tom's option tools. I want to show you how that's set up. So I'm going to pop on over here. This is our software. All right, and when you log in, you'll see a couple different areas here. Option Trader, which is really platinum on steroids. Then we've got Contrarian Trader, which is the Option Trader Plus, our Elliott wave analysis without the wave count. We've got something called Complete Trader, which is Option Trader, Contrarian Trader, and then we've got some time patterns in here, something I call the Money Calendar, the Money Clock, and there's a bunch more in here too. And then we've got something over here for our partners and masters. I'm going to go into all of these over the course of the month. So this week we're going to stay in Option Trader. Next week we're going to pop in, hit Contrarian. Week after, week 3, it's Complete Trader. And then week 4, I'm going to show you something in here that our partners and masters have access to. So let me show you where I want to go. So in the Option Trader area, we can go into an area which is called Website Lists, and we can go in and edit lists. And so if I pop into the edit list area, this is where we keep all of our lists. So any of you that remember my stock list, I've got all kinds of stuff in here for me. But what I want to do is if I want to create a penny pilot list, scroll down here to the bottom, we have pre-computed lists already for you. And one of them down here is the penny and weekly stock list. And what I can do is I can throw that into my stock list if I want to, right? So let me go ahead and do that. I'm going to replace what's in here now with I've got 419 stocks or optional stocks that both hit the penny pilot list and trade weeklies. So now I can use my stock list. I actually have one called Pennies and Weeklies that I created, which is the same thing. Okay, so I call it Pennies and Weeklies. So we're going to scan that list later on. It might be tonight, might be sometime during the month of June. But I want to show you how we set that up. And you can set up many different lists within the site. But keep in mind, we came up with this idea by what the Chicago Board Options Exchange had, and then also filtering it down with weeklies as well. All right. From there, if you really want to get down to just the best of the best. All right. Now, this is a list that's always changing. And this is really for those of you that are short-termers. All right. You like those short-term option trades. I like a list that blends price and liquidity, but also with momentum. So this is an ever-changing list, but remember, it consists of stocks on the penny pilot list. They trade above $50 a share, and they trade weekly options, and they also do a little bit more, too. I call this list Tom's Movers. All right, so to get to Tom's Movers, we're going to pop over to stocks. If you look at our where we go, all right, our homepage, we have our Getting Started piece, and you come over to stocks. This is where we can spot a lot of opportunities. And options is where we can create a lot of those low-risk trades. And then in trades, we can plan and execute and manage those trades. We got portfolios and all kinds of things. I want to go to stocks, and I want to go to stock analysis. I'm sorry, stock rankers. I want to go to stock rankers. Come down 1, 2, 3, 4, 5 down. You'll see something called Tom's Movers. Right? Tom's Movers, we can take the penny and weekly. All right, that penny and weekly stock list. that we discussed, pennies and weeklies. And here's what we're going to do. This is already set up. You don't have to do anything. All you got to do is just find a list, click on search. All right. Now I'm going to take a look at the stocks. Then I'm going to come back up and tell you what we just ranked this on. American Airlines Group, Activision, Netflix, YY, United Continental. What do these stocks all have in common? Well, first of all, you do know that they are penny pilot program optionable stocks, and they also trade weeklies. You also know they're over $50 a share, because if you see the stock price, you can see they're all over $50 a share. What you don't know is that I'm also throwing a filter in there, which is a 7-day percent change filter. And what I'm looking for, come back up here and take a look at the wizard criteria. So last 7 days, has to be above 50 currently, has to move every day. The high-low has to be at least 1% of the stock price. So it has to be a mover, all right? Has to have some range to it. And then what I do is I rank it by correlation to the stock market over the last 20 days. So why did American Airlines show up at the top? Because not only is it meeting the criteria of stock price and movement, but it also is correlating 96% with SPY. That means it's highly tracking the S&P 500. So is Activision. So is Netflix. So is YY. So is United Continental. Interesting, guys. We got two airlines there. You come down a little bit more. Here's FedEx. There's a transportation stock. But anything above 90, I'm interested in. Okay, I'm interested in looking. Now, I'm going to jump ahead because I want to kind of show you something really quickly. We're going to learn it eventually, but I'm going to show you just how fast that I'm talking about here. Let's take our top 10, all right, that are above 90% correlated, our top 10 movers and shakers. All right, what I'm going to do is I'm going to type in the number 10 here, and I'm going to save that into my stock list. I actually not want to add to it. I want to replace it. So now I'm only looking at 10 stocks in my stock list. You know what I could do with that? And once you get familiar, it's kind of like riding a bike again, all right? It's why I refounded Optionetics. I want to refine you. I want you to refine the education that 99% of the public doesn't even do, all right? So we could take that and we could go and look at something called Double Finder. And Double Finder simply tells us what stocks have the lowest move in the stock price to double in the options. So remember, we're dealing with my stock list. So my stock list, I want to see which of those. Now I haven't even looked. I haven't even looked to see what is bullish and what's bearish. All right. So don't start copying stuff down here because I'm just showing you how fast we can put together going from a list to some actual trades. All right, Anthem, there's ATVI, there's American. All right, but take a look at what happened once we reset the deck. Anthem, all right, the healthcare stock has a 7.92% to double on the calls, and then I can go in and I can say, well, let me look at the picture. And we have these intuitive pop-up graphs here at Tom's Option Tools where you can pop it up and then you can release it. All right, and then I like look at Activision. So I look at Activision Blizzard and I go, wow, okay, shooting off to the races, all-time high. Wow, these look pretty good for someone who's saying, don't look at these. Let's look at American Airlines. All right, so again, pop up the picture, and it too is just broken out to new highs for the year. And so pop again, picture's gone. I've got my news here. I've got my chart that we can look at the actual change. I got the option over here that I can look at the idea. We can do all kinds of things, but it all starts. Remember, all of this starts, in my mind, with some sort of rules-based trading, which is where we're going to end up at the end of this month. So that's our Double Finder tool. Okay. So as you can see here, we just simply are taking a big list and doing something just a little bit better than everybody else. We're able to knock it down into something that's tradable. All right, because trading profitably is all about trading consistently. And if you look at, for instance, I find that in my lifetime, there's a lot of things I'll never be. I'll never be a professional baseball player. I'm barely an amateur baseball player. Hitting a round ball with a round bat is just something that I just cannot do, all right, consistently. I'll go to the batting cages just to exercise my arms. But what I do know is the difference between getting the minimum, being a minor league ball player and a major league ball player is fractions in terms of batting averages, right? Now, obviously, it takes more than just that to be a major league ball player. But if you can hit the ball just maybe 10% better than the average, that adds zeros onto your paycheck, right? Same is true in trading. Knowledge in the right area is power in trading. So we can look at the most volatile trading times too. This is areas where you may want to be in or not be in the markets, right? And so you could look at things like a monthly calendar, economic reports, or 24-hour day in the markets. I want to look at the monthly calendar because as far as options trading, to me, that's the most important area. So people always say, Tom, what's the best, if you were to pick the best day to get into the market, what's the best day? What's the most liquid day? The most liquid day on any given week is a Wednesday. Do you know why? Wednesdays are more often than not, there's not a holiday before or after that. Now, Thanksgiving is on a Thursday, I know, and sometimes we have holidays on Tuesday, I know. But do you know the majority of the holidays that are out there fall on Mondays? All right. So Wednesday is the best of the best. Tuesday and Thursday would be the second best times to be looking at days to enter or exit based on liquidity. Okay, that's where the most option volume actually trades, Tuesday, Wednesday, Thursday. Do you know that's also the days where most corporate earnings reports come out? Do you know that's most of the time where most government and economic reports come out? All right. I know somebody's going to say, but Tom, what about First Friday? What do you do on First Friday? That's a three-peat. You got the labor statistics, you got the unemployment, and you got average hourly earnings all coming out at the same time. What do you do on that day? Personally, I take that day off. I don't trade on First Friday. First Friday, I go down to Main Street because that's when they have the music and they have. I take that First Friday is a day I take off from trading because it is the most volatile day. And that's a day where you get a lot of the more volatile the market is, the wider the bid-ask spreads get. Now, I'm not saying Tuesday and Wednesday and Thursday are volatile. I'm telling you that that's where the most volume comes in, which actually makes these spreads decrease. Okay? Again, the rule, not the exception. So fill in your calendar, all right? And keep in mind that Tuesdays, Wednesdays, and Thursdays make the most sense on days that you want to trade. The areas that are closed on all major holidays, keep in mind the day before is going to be a light trading day, not the best day to be getting into or getting out of the markets. All right. First Friday, I don't like trading First Friday. The third Friday in the U.S., which is the monthly options expiration, quarterly triple witching, these are areas which can become volatile too. And last bit of information where I will never trade is that I just simply do not like getting into or out of a trade during the last hour of the U.S. trading day. So between 3 and 4 p.m., especially on Fridays, you start seeing volume drying up. You start seeing open interest going down. And the closer you wait to the bell, the worse fill you're going to end up getting off of the bid-ask spread getting too wide. All right. So now let's talk about options, and I'm going to spend not that much time on this because all of you in this room, all right, should know the simplicities of options. I'm going to summarize them for you. Okay. So why do we trade options? We trade options for control, protection, and also paying for protection. The control is the leverage factor. The protection is protecting against your stock or portfolio, and paying for protection could mean spreads, both directional, diagonal, and delta neutral. Okay? Types of options, when it all boils down to it, there's really only two types of options. There's calls and puts. Calls give you the right to buy. Puts give you the right to sell. Okay? Calls, the right to buy, puts, the right to sell, and I'm talking about the purchaser of those, not the seller, but the call buyer, the put buyer gives you those rights. Now I have calls kind of highlighted in green there because that's what I'm going to be talking about using a case study, which is near and dear to a lot of us, which is Apple. So Apple's been trading around that 155 area. All right. And what I've done is I've taken a chart of Apple. I put it on the screen here. This came right off of our tool set, and we've got channels that are added on top of this. And as you can see, now I got up, down, and sideways channels. I can have up to 3 channels at one time coming up on the screen. When you got the majority of the channels heading in one direction, that's a good thing if you're, especially in this case, if you're long. All right. So we have here Apple. The trend, long and short term, look to be going up. Right. That's the first analysis of this. Okay. What if I had the right to buy Apple at $155 a share instead of the actual stock itself? This is where we look at the difference on control. For those of you that are newer to options, right, and some of you may be, the questions you might have about buying Apple at $155 is how many options can you buy at $155 a share? That's called our contract size. Can you buy Apple stock options at different prices under $155? That's what's called strike prices. How much time do you have on your option? That's called expiration. Let's talk about each for a moment. Contract size. I like to say 1 equals 100. That means that for one contract is good for 100 shares of stock. That's in the U.S. and in some other countries. There are a few countries that actually have 1 equals 1,000, where one option contract equals 1,000 shares. Now, a lot of people ask me why that is and how come we don't have the 1,000 shares. Because some countries, they have stocks where the majority of their stocks are less than $10 a share. So they want to have that leverage. Because owning one contract of a $5 stock and you only have 100 shares, it's not that much leverage there. That's why they beefed them up to 1,000 in some countries. Details, 155. Well, 155 would also be called the strike price if you're looking to have the right to buy Apple at 155. That's the price agreed upon. The buyer can exercise that options contract for that price. They could also sell it to somebody else, or they could just let it expire worthless if it goes in the opposite direction. And expiration dates? Well, there are several different expiration dates. You know, I remember years ago, we only concentrated on one. But there are a lot of expiration dates now. We have the third Friday of each month, which will always remain the most liquid option traded. By the way, what I do is I still lean into the third Friday options. That's where everybody is. That's where the monthlies are. Think about this. Next week, we have an options expiration that's occurring on the 16th of June. All right. That is a weekly option right now, but it's also a monthly option for anybody that's been trading it since the end of May. It could be a 60-day option for people that traded it earlier. It could be a 90-day option. It could be a 6-month option. But for all those type of traders, the one thing's the same. And that one thing is that the option expires next week. Doesn't matter whether you're a 6-month trader, 3-month trader, 1-month trader, 1-week trader, and all of that's converging into next week. That's why I believe it's the most liquid. We have weeklies, which expire each Friday at 4 p.m. We now have Wednesday options for the SPX. By the way, before any of you start asking, do I trade Wednesday options? Do we chart Wednesday options? And the answer is no and no. No, number one, because I won't trade anything until it's been out at least a year. And no, number two, because, again, I don't want to put something on our tools that is illiquid. All right? There are also end-of-month quarterly options and leaps. End-of-months are also illiquid, but they're there. Sometimes those end-of-months fall on a Tuesday, Monday, Wednesday, whatever. Sometimes they fall on a Friday. Quarterlies are the options that expire on the quarters, which are March, June, September, December. And then there are leap options. And leap options are long-term equity anticipations. Basically, it means it's a 9-month option or greater. And those will expire depending on whether you're looking at American or European exercised options in December or in January. Which are best? Well, I have them, for a trader like me that's a monthly trader, or a weekly to a monthly. I think the third Friday is the best. I like weeklies, and then I start looking at the longer term options. Now, where can you find this information? Well, this was a chart of Apple. So what I did was I went into our option chain and I looked at Apple and I thought, okay, where can I find information on our site? If you see here, we have 3 columns, the expiration date, as you can see, and we have changed that to where it's the actual physical day. It doesn't say week 1, week 2, week 3, week 4. It says July 21st, June 23rd, June 16th. Next to that, we have number of strikes. All right. You want to know where all the volume is in a stock by looking at an option chain? Just find the one that has the most strikes. June 16th, that's the third Friday in June. Next week, 96 different strikes. And of course, our days to expiration. Over here, we have all of our controls. I like to look at things in the percent to double format. That's my favorite when I look at things. And I can also change my for Apple to anything, any stock symbol, and then how far up or down from today's stock close do I want to look. From there, that gives me the data that I need to start looking at options. These are the strike prices very recently on Apple. These are the 2017 July. Now, there's a reason I like Apple right now. All right. There's a couple reasons I like Apple. Number one, the chart looks good. Number two, it obviously is hitting new highs. There are some interesting announcements that are coming out on Apple that are moving forward. And of course, this all rolls up into the September announcements that they make when it comes to iPhones and any other new products. Typically, this particular stock likes to climb in a couple of areas. As we get closer to earnings announcements and as we get closer to product announcements, typically tends to climb higher. We'll get to that in just a moment. But what you see here is call options. I just cut out and expanded the calls for July. So I've got 150, 152.5, 155, 157.5, 160. Each of these show the bid, all right, the mid price, and the ask. All right, so we know the bid and the offer, and we know what the middle price is. That gives us an idea of how cheap or expensive it's going to be past what I call fair value. Then the next column, we've got extrinsic or time value. So I can immediately look at these and I can say to myself, okay, the 155 calls have $2.51 of time value because guess what? They're out of the money, slightly out of the money. The 150 calls only have $1.57 of time value because they have real value in them. We also have implied volatility, and that's also in the bid, the ask, and down the middle. So when I look across here, there's a blue box around the 157.5. That means in this series, this option has the lowest implied volatility of all of them in the series, but they're pretty close together. The delta. We all know what delta is. That's the rate of change of the option relative to its stock price. Typically, at the money deltas are around 50. Out of the monies are lower than 50. In the monies are higher than 50. As you can see, the higher the delta, the more real value the option has, the more it's going to move like the stock on a dollar for dollar basis. Then we got percent to double here, which I start looking at. And I go, okay, so are you telling me, Apple, that all you need to do is move less than 4% for this option to theoretically double in value? And the answer is yes. The other columns are self-explanatory. You've got volume, open interest, and strike. Everywhere there's a color code, that means something, all right? Lowest volatility, blue. Lowest percent to double, yellow. Highest volume, green. Highest open interest, orange, right? It's found on everything that we offer on the tools. Now, quick definitions. In the money has mostly real value. Out of the money does not have any real value. At the money is still has no real value, but is the most expensive. It is the most expensive of the time value of options, not price, but time. Now, options that expire in the money. And I know some of you have had this happen to you. If you have an option that expires in the money, if it's a call option, you're going to end up with long stock the following Monday.
If it's put option, you're going to end up with short stock the following Monday. Now, the good news is most brokers are going to email you and call you and they're going to bug you and tell you, hey, expiration's drawing near. You need to do something. All right. Now, what about out of the money or at the money options? Well, both of these, if options expiration happens, will expire worthless. That is great if you sold the option. Not so great if you bought it. But what about a spread? It all depends. The last piece of the puzzle on options is volatility. And volatility is really the speed of the stock relative to its time. So there's two types we use when we're trying to predict stock movement. Statistical volatility, which is based on the movement, the past move of stocks, and implied volatility, which is really the present based on option pricing, present and future move. So I want to show you another chart with Apple. This is the statistical volatility chart of Apple that you can find on our tool set. So when I look at a case study and I look at Apple, I want to see a couple things. I want to look at trend, and I want to look at patterns, and I want to look at everything I can find. But then as an option trader, I want to look at a couple of other things. Now, right now, what this saying is that the 6-day and 10-day volatility, that's the red and the blue, are bouncing off the bottom and starting to move a little bit higher. That's good. That tells me that the stock is starting to move again because it was moving great come the end of May. But over the last 10 days, Apple's kind of ran out of steam. But in the last 6 days, it started popping back up again. This is great. Great news for people who want to see Apple move. This is the implied volatility chart. This tells you based on the option prices how cheap or expensive Apple options are. Now take a look at this. When do the options spike? On the 7 to 30 day trades, right before earnings, and then they get shot back down again. And look at what happens between earnings. We get this lull where it gets real low in volatility. Then it pops back up again, only to drop again. So one of the ways I want to be a buyer, I do not want to buy options on Apple right up here. All right. And the neat thing is although I really believe it's harder to predict price than it is to predict volatility, because we have reports, we have scheduled reports that are going to tell us when options are going to get expensive and when they're going to get cheap. And that's what this does, right? Nobody else out there has the details that we do when it comes to implied volatility. We have years of this stuff, okay? And it's available to our group. Now, let me show you a little bit about Apple price and Apple IV. This is, let's face it, all of us in this room can draw trend channels, okay? I showed you a trend channel. They auto draw on our tools, but all of us could draw them. But can all of us do this? I think not, all right? What we've learned about Apple, and I'm going to be showing you this in more detail over the coming weeks, but we know that Apple's moved up 9 in the last 10 years between mid-June and mid-July, before its earnings announcement. And look at the IV. Apple's IV moves up an average of 33% prior to the earnings report. So, Apple looks like a very, very interesting trade. And if we did a side-by-side comparison right now, the stock versus that 155 call, we would see that the stock's going to cost us $15,500 if the stock's at 155. All right? And yeah, at 160, we'd have a profit of 5 points. That'd be about a 3% return on investment. The call options, around $250, all right? Much less than the cost of owning the stock. We do have a higher break even, but look what happens if we go to 160 on the right. 100% return on investment in terms of what those options should be valued at, because a 155 call is worth 5 points at 160. That gives us a profit of 2.5 points on a cost of 2.5 points. This is the detail page of Apple long July. This is the first week of July 7th, 155 calls, $2.50. Okay. Shows us that it's going to cost us $250. We also know that the maximum profit and the max profit, the risk and cost is unlimited, because that's the way calls are. That's the way they're meant to be. You can't get a limitation. It's unlimited until you take it off and exit it. All right. This is what the risk graph is going to look like. This is a modern version. Many of you are familiar with this modern version. I want to mention that in our risk graphs, we actually have the ability to, when you move the mouse over, you get a little pop-up chart that tells you where you are in terms of stock price, profit, or loss on the graph. All right, we'll look at one of those today. This is the IV graph, and this shows me IV and IV risk on the calls. And the fact that if IV goes down to 12, right, which it could do, if IV goes down to 12, today that's going to represent about a $75 loss on our position if everything else remains the same, okay? With 22 days to expiration, then that loss increases to just above 100, right? With 11 days to expiration, that loss would increase to just above, just above 150, and so forth. Okay, so that's how you look at the IV graph and how it relates to your trade. By the way, the more that these stand up from top to bottom, the less volatility risk you have on that particular position. So that's calls. Trading puts. Puts are pretty much the same way, only the difference is that we're using those in down markets if you're buying them. They have the same 1 to 100 contract sizes calls. They have the same number of strike prices, expiration dates as calls, but puts increase in value as a stock price decreases. Okay, so now I'm going to move us over and we're going to look for a put trade. All right, what we'll do is we're going to do something called spot the opportunity, create the low risk trade, and plan, execute, and manage the trade. So what I'm going to do with you, I did similar with Apple, but I'm going to show you kind of a way that I do it with something that's relatively easy. So got the question in the room that said, what made you so bearish on retail, and what made you so bullish on like an NVIDIA? And one of the ways I look at this is something called HighLow. HighLow is very easy. Everybody in the room can do it. All right, let me show you how to do HighLow. So HighLow works like this. First thing I'm going to do is I'm going to pull up my HighLow ranker. And to get to my HighLow ranker, it's a ranker, so we're going to go to Stocks and Stock Rankers. I'm sorry. It's an analysis tool. My mistake. Stock analysis, and go to HighLow. And when you go to HighLow, you'll bring up the HighLow screen. And the HighLow screen, we can go in and we can look at a multitude of stocks. For instance, we could look at, well, let's just do a quick look at our stock list. Remember, there's only 10 stocks in there. So very quickly, I can see that all 10 of those stocks are near their yearly high. All right, how do I know that you're near a yearly high? Look up here for a second. Number of weeks in the HighLow ranking, 52. I'm looking at stocks with the latest highest close for the weeks chosen. And I looked at those top 10 stocks in my stock list. Right? Now, it might be easy to go and look at Anthem like we did. And, we can do that pop-up pick again and go, wow, Anthem's looking pretty good. And then we could go and just simply create a trade off of this. All right? So, I could go in and just go to options and go to option chains. And I'm going to turn this into ANTM, Anthem. Let's go ahead and click on update. And so, this might be a trade that we may want to look at to the third week of July. So here's our first, second, third week of July. I'm going to check mark that. That's when I'm unchecking, I'm making these strikes disappear. I'm going to make this strike illuminate. When I click on update, the strikes will appear below. There they are. And I'm going to look at Anthem real quick. And I'm going to say to myself, all right, I like this. Let me look at, for instance, a call option. So I'm going to click 1 for one call option. Click on risk graph. And by the way, our particular processor, the tool we have here, runs at a speed of 10 times what Platinum ran. We have something called fast risk graphs, which will pop up just as fast as you can click on them. So we have a very fast program, and it's actually intuitive too, by having pop-up charts. I'll show you another intuitive feature of this. So this is $363. Again, the unlimited, that's the call option. But I'm more interested in seeing what happens if we get up here near the top of this cone. Right, so you see this particular cone here, this probability cone. or probability or standard deviation graphs. Here's the intuitive piece I'm talking about. Let me put my finger right there on the mouse. So at $199.91, Anthem stock should deliver us a profit of just under $700. All right, that's what this does. Now, Anthem comes back down. I can see immediately that I may have at $177.87 a $291 loss. This is what I'm talking about when I talk about intuitive graphs, as you can see here. All right, so that's one way we can do this, but I want to show you the answer that I got to the question of how do we utilize this? How do we utilize the high-low? So let's go back, and I'm going to bring up high-low once again. So remember, stocks, stock analysis, high-low. We get to the high-low, and from here, I'm going to now look at my pennies and weeklies. My pennies and weekly stock list that I just created with you just not too long ago. And what I'm going to do is I'm going to look at stocks with the lowest close for weeks chosen. Let's see what is down in the dumps right now in terms of the top 419 stocks and ETFs. Here you go. Macy's at a new low. S&P gas and oil exploration, a new low. Noble, that's oil, new low. Market Vectors oil, new low. Neighbors, energy, low. Transoceanic, low. Rite Aid, pharmacy, low. Crude, low. Schlumberger, low. I mean, these are, look at this, guys. This is just a glutton of oil, no pun intended. You got a couple retailers on here, too. You got Macy's, you got Rite Aid, Bed Bath and Beyond. I was saying last week, my mother-in-law, God bless her, she's full Italian. She starts English and she ends in Italian. I only can understand half of what she says. She was talking about bed. She goes, I need to go to the Bed Bath and Behind. And so that's the big running joke here at the Gentile house now. Bed Bath and Behind. I like that because when you take a look at Bed Bath and Beyond, at a picture, let's do the pop-up. It really is Bed Bath and Behind because look at where it was late last year, up at 48. Look at where it is today, below 34. Bed Bath and Behind. Okay, so I'm showing you this because we can take a look at the dogs, all right? And I'm not talking about dogs of the Dow. I'm just talking about the mess, all right? The stocks that have been taken out to slaughter. And let's take, wow, the 100%ers are just amazing. There's 23 of them. Let's take the 100%ers. Let's take the 23 stocks. And remember how we do this, guys? We're going to save those 23 stocks in my stock list. I want to replace that. I don't want to add to the list because then I'm going to have stuff in there that shouldn't be in there. I'm always replacing my stock list with something else. All right. Where are we going to go now? Let's go on over to Double Finder. All right. Double Finder. And I'm going to go in and I'm going to say, I want to use, now follow along with me. Here's some option search criteria. I'm going to use lowest percent to double. And I'm going to come down here and I'm going to make sure that this is on my stock list, not the pennies and weeklies. My stock list, those 23 stocks. And so I want to see lowest percent to double puts because these stocks do not look like they're moving higher. Right? At this point, we can come down and click on search. And within a few short seconds, there's 6 seconds, and we have results. And our results are Schlumberger, Schlumberger's Bed Bath and Beyond. Let's look at Schlumberger for a moment. This one has the lowest percent to double. And so again, let's take a look at that pick. That's an ugly looking chart from $88 a share down to $68. Ugly. Let's take a look at the option for $1.98. What, pray tell, is this option? So here's our option. It's a put option. That means the lower the stock price goes, the more this actually goes into the profit zone. The trade is actually the August 18th That's how far out it's going, not July. It's saying you got a better pick in August based on the percent to double here. 67.5 put, less than $2 to buy, $198 risk. Look at that. Now, we all know Schlumberger is not going down to zero, but just in case it did, 3,309% reward to risk ratio. All right. So there's your trade. All right. Pretty cool stuff. Pretty cool stuff, guys. Spot the opportunity. We use the high-low strategy. Create the lowest trade. We did the double finder. Planning, executing, and managing the trade. Well, that's where you go in and you utilize things like, for instance, if you were to go into our trades themselves, you could go in down here. We've got a trade plan section where you could put in what your entry rationale is, your targets, your stops, your stop losses, anything else you add in here, and then you can save that trade. And you can save that trade for further viewing. Okay? So we do it all right there. But it all starts, again, spotting the opportunity, creating a low-risk trade, plan, executing, and managing the trade. Now, I want to share with you my market outlook this week. I do my market outlooks every Wednesday evening. Just so happens it's Wednesday, and we just got this thing together. And so this is an outlook I do. It's 5 minutes or less. It's actually becoming more like 3 minutes or less. Stocks, bonds, currencies, commodities, and more. We make that available to all of our students weekly. All right. The details for this and what we do is we have the details. We have scans. We have setups. We have case studies. Those are all available to our tools members. We have a newsletter that we have for those who are our complete trader members, partners, and so forth. But let me just show you a little bit about what that looks like. So this is what I'm going to be. I'm actually putting, once I'm done tonight with you fine folks, I'm going to be doing a video and I'm going to make that available. And that'll be up, and actually it'll be not only in our tools videos, but you can get that on my YouTube channel. By the way, no commercials on my YouTube. I don't monetize that thing. I hate looking at commercials on YouTube. So YouTube channel is youtube.com/Tom's Trading Room. Jay, can you please put that into the chat room? www.youtube.com/Tom's Trading Room, so that these guys can subscribe, and then you'll get my videos each week. So we're looking at the S&P. We're just showing you right now. We talked about this last week, that we mentioned that we were expecting a new high, and that's what ended up occurring. And now we're getting another continuation set up, perhaps. But the ranges are getting tighter and tighter. What's really interesting is when you look at the media, I get the Wall Street Journal every day. It still shows up at the end of the driveway. When I pull that thing open and I start looking at it, it almost makes me want to sell the market. Yet this market continues to move higher. Remember, folks, trade what you see, not what you think, and especially not what you read. All right, trade what you see. That's very important. So what we're seeing here is we're seeing no reason to get to the bearish side short term. All right, maybe longer term, if you're looking at sell in May and go away, that might have a reason. Okay. But the S&P, now what we do is we look at stocks and then we try to do some confirmation. Let's do some confirmation real quick. This is bonds. This is the TLT, which is the iShares Barclays 20-year Treasury. We look at this on a weekly basis. Now, here's the thing. When stocks go up, this chart should go down. When stocks go down, this chart should go up. Now, we're going into a really weird window because this thing's been making new highs and the stock market's been making new highs. And guess what? Somebody's going to have to cry uncle and move in a different direction. So what we're showing you here is that old resistance may become new support. We have to really see what's coming out of the ECB this week and what's going on with the Fed next week. So we may need a week before the chart clearly tells us where we're going. Now, I'm already seeing questions that say, what's the B and what's the S? All right, that I'm going to share with you next week. Okay, but yes, those, we didn't just paint them up there before we started. They're up there, they stay up there. And when we get new ones, they show up too. And when we do get these, we let our readers, our viewers know. That's our darknet strategy, which I'll be giving you a detail on what that actually is next week. Take a look at FXE. So stocks, bonds, right now they're not telling us, they're contradicting each other. How about FXE? FXE is what we call a risk-off asset. What that basically means is that when our markets drop, Europe's currency tends to rise. That's kind of gone and derailed itself since the election in France. So now we have, and I have the note up here, prices on FXE haven't seen these levels since back in September 2016. Guys, we pegged FXE to become par with the dollar by the end of last year, and it got dangerously close. Since then, it's made a move back up, and it's now trading up somewhere close to 8% off the lows that happened earlier or late last year. So again, this is going to be, a lot of this is going to be based on what the ECB does. We'll know later this week. But again, it's not telling us that there's any confirming evidence that the stock market is going to go higher either. So then we look at oil, and good old crude oil, which has been in a glut. All right, this is a commodity. I'm going to bring one up, and I'm going to show you one on the screen, show you what we can do with it. But oil, again, we had a lot of great buy and sell signals using Darknet. I'm looking for the next one. But you can see today, it looked like yesterday it wanted to turn around, move higher. And then, of course, after the 10:30 announcement, boom, goes the dynamite. And that dropped USO right back down to the lows of the year. So going to be very curious to see where this goes from there. Now, before I move any farther, let me show you where I get these charts. So if you go to stocks and you go to charts and you go to stock charts, you can bring up this chart just like I'm doing. But I can do all kinds of neat things with these charts. So, for instance, let's look at GLD because I'm interested in gold. And what I'm really interested in is why is gold moving higher with the stock market? Hey, if you've got gold as a hedge against your portfolio, you are doing double good because gold is back to making new highs for the year. All right. And I own a bunch of gold, so I'm not complaining. I'm not complaining at all. But let me just show you a couple other things we can do with these charts. How about if we could put the implied volatility right on top of the chart? We can do that. The overlay, let's put the 7 and 30-day IV on. And there we go. So as the stock, as gold moves higher. Now remember, you might say, but IV's moving lower. Well, it is for the long term. But look what's happened just in the last couple of weeks. Gold's moved up, and short-term IV's been moving higher as well. All right, let's do a channel test on this. Come down here and click, and we can click on up, down, and sideways. And let's just hit channel test until you start to learn how to use that. Just use the defaults. Well, the long term is up, but the short term and the intermediate term are really kind of moving sideways. We really need to see a close above yesterday's high before we start to see a change in all the channels moving higher. But this is great if you're a gold bug, or if you like gold stocks, because gold has been performing quite well the last 2 to 3 weeks, right? And we can do all kinds of other things on here as well. Let's see if I can give you a chart type. Come on down. Let's look at Darknet, and we're gonna look at this next week. I'm just gonna tease you a little bit real quick. Do we have any Darknet trades on gold? Look at this. We had a sell signal that was from a buy signal beyond the chart. But take a look at this buy back in mid-March. This was around 114. Got to sell at 120. Buy came in at 116. The sell came in around 120. And, of course, the market moved higher after that. But this is something I'm going to be teaching you with channels and how we trade channels using Darknet next week. All right? So, your homework for the week. I want you to, first of all, create a stock list for yourself using the rules that we outlined. Okay? I want you to create a risk graph and an option trade on Apple using the July options. And I want you to ask yourself, how can we make this cheaper? Can we make this cheaper than we already have and still be in a good quality option pick? All right? I have a 120-page book I'd like you to read called Trade Like a One Percenter. That is my 2017 edition of that is hot on the press right here. If you go to the handouts, you'll see it as a handout. I'd like all of you to download that handout. If you haven't done so, do it right now. Download the handout. All right. That is, if you like, you can go to Amazon. You can buy the book for $49, or you can download it for free right now. And for those of you that had the older version, I have the 2017 version here for you. You might want to download it as well. And then finally, our tool subscribers. Jay, if you haven't already put it out there, in fact, I'm actually going to put it out there for everyone, because there's a couple places you can go to get this. But really, the best place to go is if you go to http://www.tomsoptiontools.
I put the YouTube link in there.
You've already put that in there, huh?
In the chat window.
Cool.
Yep. You and I both got it. All right.
Awesome. I'm not done yet, guys. I want to share a couple other things with you here. So, so I'd like you to do a little bit of homework for me. I would like you to download and read the book. It's right there. You can grab it. All right. Obviously, for those of you who are getting this by way of recording, you cannot download it. The good news is I'll have it available in the email that this particular video came with. And finally, like I said, new subscribers. If you're a new subscriber, you've never tried us before, we have never given 30-day free trials before. You know, it's been mine and my programmers and my team's assessment that you will know in a week or less whether this is for you. However, because of the Optionetics, because of the welcome back celebration we're doing, we decided that for the remainder of this week, we are offering that 30-day free trial. And that is going to be good until Sunday night at midnight. All right. Once Monday comes around, that goes back to a 7-day free trial. So for those of you that are interested, check us out, try us. You have 30 days to try it. The sooner you can get in there, the better. And let me tell you what that free trial comes with. In fact, I'm going to show you exactly what it comes with. I'm going to click on tomsoptiontools.com because I want to open up that site. I'll just do it right over here. Here we go. And give me a moment to log in. Jay, you still there? Hello, Jay.
Yeah.
Okay.
Yes, I'm here.
I guess everybody's hitting us at the same exact time.
Yep.
Go into Tom's Trading Room or tomsoptiontools.com. You'll see my bright and happy face over here. Look up at the top where it says 30-day free trial. If you click on that little green window that says free trial 30-day, that's going to take you to our trial pages. Now, we have option trader, contrarian trader, complete trader. The professional trader, our membership is full. We may have some of those open up later in the year, but right now those are full. But if you take a look at these three, if you're interested in getting something very similar, well, not similar, something that's options oriented only, you can try out our option trader. If you are interested in something that includes our contrarian trader, which is Darknet, we have a trial version of that. We also have a trial version of our complete trader. Let me tell you this. If you're not sure, take the big one. The worst you can do is always go down when it comes to deciding on a package. All right. This package, by the way, is regularly $3.99. It's at $1.99, but you get a month free trial. So to start your free trial, you just simply click on your free trial. You're going to see a terms of service. You're going to click on I agree. Once you've read that and you do agree, you're then going to go in and fill out some information. All right. You do not need a PayPal account. All right. If you have a PayPal account, it's great. But if you do not have a PayPal account, it's fine. You don't need a PayPal account because underneath the area it says log in on PayPal, you're going to see below that it's going to say use guest checkout or guest checkout by credit card, and then it'll take Visa, MasterCard, American Express, Discover. All right. You would also obviously you'd want to create a username and password for yourself. Type this image in here and submit, and then you just move along and subscribe. Once you subscribe to this, you will be charged nothing, all right, for the first 30 days. You will instantly have access to the tools, all right? I think instantly I might say 60 seconds. You have to refresh the page and then log in, and you're in, all right? So that's what we have for the actual subscribing. Again, you can choose one of these three: option trader, contrarian trader, or complete trader. You'll get a full 30-day free trial to those. All right, tomsoptiontools.com.
Guys, next week, what we're going to do is we're going to review week 1. We're going to review your homework. We are also going to talk about spread trading, all right, and how and why I trade spreads over simple calls or simple puts. And then we're going to get into a spotting opportunity piece that we like to call trading the darknet strategy, all right. This is an example. Blackstone over here that I just brought up, that gave a sell on the darknet strategy up here around 33.5. The buy was down here at 30. If you don't think that 3.5 points is enough, you need to have a double on an option, then you need to revisit today's session. All right, because it's more than enough. Guys, thank you very much. I hope you enjoyed this week 1. That's by the way, we did a cruise last year with our Tom's Trading Room group, and hopefully we will do many more like that so they can see me. There's Mike Wade, there's Christina, Devin, Nick, John, and Jay, and all the rest of the gang with us. Again, hope you enjoyed this, guys. A lot more to come. If you, again, have any questions at all, you can reach us, support@tomgentile.com. All right, that's where you want to go. Support@tomgentile.com. Thank you very much. Have a great night. I hope to see all of you in here next week. It's been fun. Till then, good night, guys. See you, Jay.
See you, Tom.